Stock Market for Beginners 2018 edition. Well, welcome in. I am Jeremy. This is a financial education channel, and today I'm going to teach you as a beginner in the stock market, as someone just kind of getting involved with the stock market, what are the steps you want to take, how do you want to approach this and whatnot. The hardest thing, as with all things in life, whether it's investing, starting a business, anything, the hardest thing is just getting started and knowing which route to go and all those type of things to do, guys. So as someone that's probably newer to the stock market, if you're interested in this video, I'm going to help you out immensely today. The last time I did one of these videos, I think was 2016. It's now 2018, so it's time for a little update, guys. I hope you really enjoy this today. Make sure you subscribe if you want to see a lot more stock market videos. I post a lot of stock market videos on this channel. So, stock market for beginners, where the heck do you start, okay? First off, like the attraction to stock market investing is that you can make your money into more money. So if you're getting involved with the markets, obviously that should be your goal, right? To make your money into more money. Obviously, if you're getting involved with the stock market, obviously with all investments, you can lose money as well. So you always got to think about that. But there's a lot of money to for sure be made out there in the stock market. That's up for you to do. So you want to get started. What's the kind of like the first things you need to do? Well, the first thing, in my opinion, is you got to figure out like what type of philosophy are you going to do in the stock market? Do you want to be a trader? Do you want to be an investor? Those kind of things. So you got a few different options. The first is you could be someone that's called a day trader, okay? You could be a day trader. This is not something I do. This is not something I recommend at all, but it is something you can do in the market. This type of activity, you have to do a lot of research as far as technical reports. You have to look at a lot of graphs and things like that. You're not really making investments in companies, and you don't really even care about a company, okay? You don't really care about a stock. You're just trying to make quick money and get in and out of stocks, trade them several times per day, get in and out, and those type of things, okay? It's not a philosophy I'm into at all. However, it's something you can do, and it is an option for you. You can be also what's called a short-term trader, okay? You can be a short-term trader. Another thing I wouldn't recommend at all, guys, this is not something, I'm into at all. I've tried this before, and I lost a lot of money doing this, okay, in 2015. This is where you go into stocks for maybe a week, maybe a month, maybe a couple months, and you're just trying to play events. Like companies announce earnings every 3 months, so 4 times a year they announce earnings, okay? Every 3 months. So a lot of people, what they do is maybe they expect a company to have good earnings. Maybe they will buy into that stock. They'll go long that stock, as it's called. Or maybe they'll short shares, which is actually basically betting against those shares if they think that company is going to do bad and they're going to report negative numbers, okay? You as someone just getting in the market, you're probably 100% of the time going to be going long in stocks, meaning you're buying stocks figuring it's going to go up over time. So this is not something I would really recommend. This is a lot of speculation in there. This is, once again, not really investing, okay? The third route you can kind of go is options, okay? You can do options trading, which I actually have an options course. It's the second link down there in the description. I would not recommend that for any of you beginners out there. Options, in my opinion, it's fine to learn options if you want to learn about options, but as far as actually doing them as a beginner in the stock market, I do not recommend it at all. I would save options for when you've been in the markets a couple of years and you kind of got some experience behind you and you really know what you're doing, okay? It's options, you can save yourself a lot of money. You can also potentially make yourself a lot of money, much more money with much smaller amounts of money. But for a beginner in the stock market, I just don't recommend it. I don't think it's the right way if you're a beginner in the stock market. I think once you're an advanced investor and you've been in the markets for a while, you can start doing a lot of different option things and understanding the power of options. But for a lot of you that are going to be beginners in the stock market, I don't really recommend it, okay? The fourth option is kind of, which is really my philosophy, which is what I call a 1 to 5 year buy and hold type strategy, okay? So there's a lot that goes into this as far as what I look for in a company. By the way, I have a full course on that. First link in the description if you want to check out that. That's my entire strategy behind like how I pick stocks and whatnot. But basically, in the simplest terms, I'm trying to look for companies that, in my opinion, over at least a year out, but over the next like 2, 3, 4, 5 years, I can see the vision for the company. I can see where the company's going, and I'm judging it off of all these things I'm looking into, right? And I'm holding it for that amount of time. When shares dip, I buy more, and I always go somewhat small when I first initially make a position in case the shares go down. I can buy more. If they go down even more, I can buy more shares. As those shares appreciate, as long as I made a good decision in that company, a good investment in that company, I can sell out my shares for a bigger and bigger and bigger profit at the end of the day. So that is more of my type of strategy. And then the last kind of strategy you can do if you're in the markets is what I call buy and hold forever, okay? So this is a type of strategy where you buy a stock and you're planning on holding it for, I don't know, the next 20 years or until you're 50 years old, until you're 80 years old. This is almost like the kind of like a Warren Buffett philosophy, even though Warren Buffett even gets in and out of companies more often than he used to, okay? Warren Buffett kind of used to buy stocks where he might hold it for his entire life, but nowadays he really gets in and out of stocks. Why do people kind of get more in and out of stocks now, you know, over a few year basis? Well, I think a lot of people have kind of moved more to my strategy because my strategy makes more sense in today's climate because things can change so fast. Companies can get knocked off so fast, guys. I mean, a company can be on top of the world. 5 years later, they're like non-existent. Think about BlackBerry. BlackBerry in 2013 had 85 million subscribers, okay, on their phone plans they had and whatnot. They were like the premier smartphone maker, and that's when they peaked. And nowadays, we look at BlackBerry, you know, in 2016, 2017, and 2018, as their phone business is pretty much non-existent. They're in a complete turnaround mode. BlackBerry's in a complete turnaround mode, trying to turn that company around now. If they didn't have so much money on the balance sheet, they could have potentially went bankrupt, guys. And that was a company that, you know, 4, 5, 6 years ago was on top of the world. That's how fast it can happen now. You can get knocked off so quick. So the whole, like, let's buy into a stock, hold it for the rest of my life, I just don't think it applies anymore because of the technology game and how fast things can change, how competitive the world is on a global scale. You have so many competitors coming in from so many places, coming in to try and knock you off. I don't think that whole buy and hold forever philosophy is really realistic anymore, which is why I think my 1 to 5 years is the best plan. So that's the first thing you gotta understand, like, what is your thing? You know, what type of investment philosophy or trading philosophy do you want to do? Which one of those 5, and those are really your main 5 options out there, okay? So now that you figure it out, hopefully, and it might take you time, you might have to read some books and whatnot on which way's right for you, and go to the library. There's a ton of different books if you want to read about some of those different ones, day trading and whatnot. You can also watch videos here on YouTube, figure out which one's best for you, okay? So now you figure that out. Now what you need to do, step number 2, is you need to open a what's called a brokerage account, okay? We'll call it a BA. You need to open a brokerage account. There's a lot of different companies out there. There's TD Ameritrade, Scottrade, E-Trade. There's Robinhood app. There's something called Robinhood app, which is pretty good if you are, if I was to say if you're investing under $10,000, which if you're investing under $10,000, I wouldn't really count you as a serious investor yet. You're kind of getting your feet wet and kind of understand things. Robinhood could be the thing for you because they actually don't charge commissions when you go to trade. A lot of companies charge between a $5 and a $10 commission when you make trades, okay? So if you're a beginner in the stock market and you got only $1,000 in the market or a few $100s or $5,000 or whatever, you know, those $5, $10 at a time when you buy and sell stocks, those could eat into a lot of your profits when you got smaller amounts of money, where an app like Robinhood is good. Now, where Robinhood is not the best, in my opinion, their customer service, okay? So once you get kind of above that $10,000 mark, in my opinion, you should switch to the brokerage I use, in my opinion, which is totally up to you. They're not sponsoring this video, but I've been with them for 9 years now, and they're freaking phenomenal, and they're called Fidelity Investments, okay? They're called Fidelity Investments, and they are freaking phenomenal, guys. As far as their customer service, I've called them up at 1, 2, 3 in the morning before to talk over options trading strategies with them, or talk about, you know, if there was ever an issue with my account. Hey, how come this trade didn't clear here, or something like that. Like, I call them up at any time, and they have phenomenal customer service, and they treat me great and whatnot. So I've never had an issue with them. Also, I would say their security overall is probably the best in the brokerage game, in my personal opinion, from what I've seen. You know, because I've obviously looked, having a bigger account with them, I've looked into a lot of their security protocols and kind of all that type of stuff. Like, what makes your, I've called them up before and asked them, what makes your security so much stronger than ABC? Why shouldn't I switch to somebody else's brokerage and whatnot? And they've kind of told me a lot of things about that. So that's kind of number two. You need to open up a brokerage account. Now, when you open up the brokerage account, it's pretty similar to like open a checkings account or savings account at a bank and whatnot. You're going to need to give your social and your first name and your birth date and all that type of stuff, guys. Obviously, because it's a secure account with a lot of money in it, they need to have all that type of information there, okay? So great. Now you got a trading strategy you're going to do. Now or an investing strategy. You got your brokerage account open. So you're now ready to kind of, you know, start getting involved with things. So now what I would recommend doing is you need to, you know, kind of figure out what websites and apps you want to use and whatnot to track things, right? So as far as websites and apps, my favorite app overall, as far as one I use day in and day out, is what's called Stock Tracker, okay? Stock Tracker app. This app is, by the way, with how many views this video will end up getting over the next couple of years, all these companies should be paying me for these spots I'm giving them. But Stock Tracker app is freaking phenomenal, guys. It's my favorite app as far as tracking prices day in and day out. You can do a lot more. There's actually a discuss section where you can see, you know, what people are posting in there as far as, you know, what they're thinking about that stock and things like that. You can also look up at a lot of statistics and things like that, guys. That's a phenomenal one. It's called Stock Tracker. I know it's available on iOS. I'm pretty sure it's available on Android as well. I just do the free version, which is like, you know, they still show some ads and whatnot. That's fine with me. I just click off of the ads if they show me one. As far as another app, I like the CNBC app. That is another good app I like to use here and there, CNBC. This one I use more for like news. It keeps me up to date on what companies reported earnings and what's going on in the political climate and, you know, what's going on with the Chinese numbers and all these different things, guys. The CNBC app is always coming up to date. You know, it's a huge company that has a lot of people always looking into stuff and whatnot. You can find out a lot of news stories from checking out that CNBC app. As far as websites go, I still use Yahoo Finance a bit, although, you know, they've gone downhill over the years. You know, Yahoo Finance used to be so unbelievable that there was almost no reason for me to use anything else. But Yahoo Finance, I do still use it. It's pretty good if you need to just kind of look into income statements, balance sheets, cash flows, statistics like forward PEs and trailing 12-month PEs and things like that, guys, in a quick amount of time. Yahoo Finance is still pretty good as far as that goes. Also, another website is CNN Money. Okay, CNN Money is another pretty good one in my opinion. It's not as good as Yahoo Finance in my opinion, but it gets the job done. Okay, so those are kind of the apps you want to have. Stock Tracker in my opinion is phenomenal. CNBC as far as websites go. Yahoo Finance and CNN Money are kind of the main ones I use. Now, the other main websites you are going to want to go to as someone that's actually, if you're looking into the company as an investment, you're going to always want to go to the IR section of all companies' websites, which is called their investor relations page, your investor relations page. On the investor relations page, basically companies have all their information there as far as their 10Ks, which 10K is like another word for annual report, which is basically a report they do every single year that kind of gives you all the information about that company, what they're doing, what their competitors are doing, who are their competitors, what type of income they did last year, what type of profits they did, what type of balance sheet they have, cash flows, what they're expecting for the upcoming year, what the risk factors are to that company. Just about anything you could possibly want to know about a company is in the 10K, or you can even look at the 10Q, which is the quarterly report that comes out every 3 months. Okay, remember I told you guys that companies report 4 times a year. Every 3 months they report. All that's going to be found on the investor relations website of a company. So let's say you were looking into Coca-Cola. You want to look into Coca-Cola. What you would do is, in my opinion, you just go to Google, type in Coca-Cola investor relations page. It'll probably be the first thing that pops up. Click on it, boom, you're in their investor relations page. Then you can see if you want to listen to conference calls, which I recommend. You always listen to conference calls, which is they do every 3 months once again, because they report 4 times a year. Every 3 months they do conference calls. You can listen to those and kind of see what the CEO is saying. Analysts ask them a bunch of questions. You can hear all that type of stuff. Very interesting and very it's something you have to do if you're really making long-term investments in companies. You have to listen to these conference calls. Also on there, like I said, the 10Ks are on there, the 10Qs are on there, so you can read all about the company, find all the reports. All the reports are accurate unless they made an accounting mistake, which would be, they would be in a lot of trouble if they made an accounting mistake or something like that. But this information is always good. And also, like I said, the conference calls are all on there that you can either get the transcripts to, or you can actually listen to them. And it's better you go there, especially if you're making serious investments in companies, because websites like Yahoo Finance, CNN Money, and a lot of these other ones, who knows if that information is completely accurate, okay? Because maybe somebody fat-fingered something and missed a decimal there or missed a comma there or something like that. You never know. It could be some mistakes. Also, you can only do so much research on those websites, right? It's a big difference between reading a 10K, which is like a 100-page report, and looking at a few different statistics on a Yahoo Finance. Yahoo Finance, CNN Money, these different apps and whatnot, those are good for kind of starting to look into a company, but when you're really ready to do the serious research in that company, you need to read those 10Ks, you need to read those 10Qs, and then kind of make judgments off of that from there, okay? So now you find your company, to invest in, you looked into it and whatnot, you're like, okay, this is the one. So then obviously you have to place a trade, okay? So you're gonna place a trade. So if you're a beginner in the stock market, like I said, you're just gonna be going long shares, generally speaking. Like, in my opinion, that's all you should be doing. You shouldn't be doing options, you shouldn't be shorting shares, you shouldn't be messing around with any of that. That's for advanced investors. You're a beginner in the market, you go long shares. So you're trying to buy shares in a company because you think it's gonna go up over whatever certain amount of time you plan on holding that, okay? So when you go into buy shares of a company, you kind of got to think about, like, first, how much money do you want to do into it? Now, you need to have connected your checking account or savings account to your brokerage account so you can funnel money into it, okay? Or maybe you can take cash down to, like, if you have Fidelity, you could probably take cash down there and have them put the cash in your account or something like that. I don't know why you'd want to do that. Just set up your checking or savings account so the money flows in, okay? So once you've done that, you're ready to make your trade, okay? So let's say you got, $1,000 of money. You got $1,000 you're ready to invest in, Coca-Cola stock. So Coca-Cola stock, off the top of my head, their ticker symbol is KO, if I recall. By the way, all companies have a ticker symbol of some kind. So, they're all different. You just kind of got to look into that and whatnot. Yahoo Finance and those websites are phenomenal for finding ticker symbols. So you want to buy $1,000 worth of shares in Coca-Cola. Sweet. So what do you do here? So you'd want to put in your order for buy. You'd want to buy, and then you want to buy, obviously, $1,000 worth. Let's just assume Coca-Cola shares right now are trading at $10. Well, assuming you got $1,000 and assuming, let's just assume this was Robinhood you were putting in the trade, so you have to pay no commission. You could buy, how many shares was your $1,000? You could buy 100 shares. So you'd put in buy 100 shares, and when you're putting in your order, right? And you can go in and do it as basically a market order. You could do it as a market order, which would basically mean that, their shares are purchased at whatever price they're trading at. So if they happen to be trading at $10 at that moment, you get them for $10. If they happen to be trading at $9.97 at that moment, you get them for $9.97. It's whatever it trades at that particular time is a market order. You could also put in a limit order, which would be basically, if you didn't want to pay anything over $10, which is something you'd want to do if you only got $1,000 in your account, because obviously you can't pay anything over $10, your account goes over, right? So you could put a limit order of $10, you want to pay nothing more, and so your shares will only get bought if the Coca-Cola shares are at $10 or lower at that particular time, okay? So that's great. And then what happens when you need to sell off those shares? So you hold them for whatever amount of time. What happens when you want to sell those shares? Basically the same exact process. Only thing you do different is you'd put in your order to sell, okay? You just put in a sell order. And once again, you could do it as a market order. You could do it as a market order where the shares trade at whatever the price is at that particular time. Or you can do a limit order where you have I only want to sell it for $11 or higher or something like that. You could put in what's called a limit order, and it will only trade at those particular prices. Now, when selling your shares, something you got to keep in mind is taxes, okay? Basically, you are taxed differently if you hold those shares for more than 1 year than if you held those shares for less than 1 year, okay? So if you held shares in a particular stock, so let's say you held those shares in Coca-Cola for 1 year and 5 days, okay? That would be taxed as capital gains at a capital gains tax rate, which is probably gonna, depending on your tax bracket, you'll probably pay somewhere around a 15% on capital gains, all right? The difference is if you held that stock for only, let's say, 6 months, 9 months, 10 months, 11 months, somewhere around there, and you sold it off, you have to pay it at your normal tax rate, okay? Your normal tax rate, which your normal tax rate could be much higher, okay? Think about it, especially if you're someone that earns a lot of money, all of a sudden you got to pay, you know, a 25% tax rate. Let's say that's your tax bracket, you're in 25%. Big difference in the amount of money you'd pay on a 25% tax bracket and a 15% tax bracket, especially once you talk about the numbers getting bigger. You talk about $10,000 plus, talk about $100,000 plus, talk about what if you have $1 million. All of a sudden these numbers start to get massive, okay? Which is another big reason why a lot of big money managers and whatnot hold for the long term, and they're trying to get in companies for several years because they want to pay capital gains tax rate on that. They don't want to pay normal income tax rate. That's a very, very different thing there, guys. So you sell your shares, hopefully you made a profit in that, and then basically what do? You just rinse and repeat, okay? You just rinse and repeat, and you keep going, and you keep sticking to your strategy, and if it works, and you understand your strategy, you go from there. Now, kind of the last part I want to talk about here as far as you know, stock market for beginners is I want to talk about your portfolio overall and what are you kind of, you know, aiming at long term. So if you picked an investment type philosophy where you want to hold either for my type of strategy 1 to 5 years or maybe long term, my type of portfolio philosophy as far as adding shares and kind of getting around position is, in my opinion, you know, as an investor in the market, you should probably hold between 4 and 9 stocks, in my opinion. 4 and 9 stocks is kind of my perfect range as far as, and I don't care if you've got, you know, $1,000 in the market. I don't care if you've got, you know, $1 million in the market. This is my personal philosophy. 4 to 9 stocks is my perfect balance there. It's not under diversified as far as if you're in only, let's say you're in 1 stock or 2 stocks. Obviously, if just one of those stocks goes down dramatically, you know, goes down 20, 30, 40, 50%, you're going to be destroyed. Your account's going to be absolutely destroyed. Now, on the flip side, if you have, let's say you got 30 stocks in your account, let's say you got 30 stocks here, right? The issue with this is how are you going to like stock number 27 anywhere even close to as much as stock number 7? Stock number 7, you know, that's a stock you're probably like kind of confident in. You know, this is even when you get to stock 7, 8, 9, these even are companies that you're like, man, I kind of believe in this one, but do I really believe in it that much? When you get to 27 stocks, at this point in time, you start getting into companies that you don't really believe in at all. Like if you had to put in my opinion, when you go to think about making an investment, you should always think like, if I had all my money in this one stock, would I be okay with that? Would I be okay if all my money? In my opinion, it's impossible to, you are not judging stocks hard enough if you have found 27 stocks that you feel comfortable having all your money in, or even a portion of your money. And the way you your mindset should be is every dollar is so important when you're investing, okay? Whether you've got a $100,000 account and you're investing $1,000, that's still important, okay? Whether you're investing $10,000 and you've only got $10,000, whatever amount you're investing, your philosophy and your mind should really be like, this is super important. Every dollar is important. You should never like take for granted an amount of money, even if it's a smaller amount of money compared to your account, even if it's only 1% or 2% of your account. Always treat every dollar like it's super important. That way you always be in the mindset that this money needs to go toward the best stock possible, okay? The best stock possible. Now, also, for investing, as far as beginners go, what type of companies do you want to kind of stick to as a beginner in the stock market? Obviously, we talked about you pretty much just want to go long shares. As far as the type of companies you want to get involved with as someone as a beginner in the market, and this is kind of the last thing we'll talk about here, is you want to get into bigger companies, okay? You want to get into big companies, okay? What do I mean by big companies? I'm talking market caps of 100 billion plus, okay? A market cap of $100 billion plus, okay? Huge corporations. These are, you know, we're talking the Apples of the world, the Googles of the world, the Microsoft, Amazon, Walmart, you know, these huge companies, you know, Alibaba. Those are the type of companies, I'm not saying any of those specific stocks you can get involved with, but I'm talking about those massive type of corporations are really the ones you're going to kind of want to stick to as a beginner. Why? Well, one, because you're probably going to understand them better. You'll probably understand, you know, what they're doing and those kind of things better because you're familiar with them. I mean, a lot of you guys probably use Apple products or use Google products or Microsoft products. You probably understand Microsoft's business model before you really even buy into that stock, or Apple or Google. You probably understand a little bit about it before you've ever even looked into that company. Some of these smaller companies, sometimes it's a lot harder because you're looking into this company for the first time ever. It's going to be really hard to understand. Also, generally speaking, these type of corporations, as far as losing money and their stocks going down massive, it's pretty rare. It would be pretty rare for these type of companies, you know, on a mass scale to drop 30, 40, 50% in a year, okay? That's a pretty rare occurrence when we're talking about this size of companies. These type of huge companies, even if they were to fall 10 or 20%, would be huge. However, smaller market caps, you know, companies that are in a couple $1 billion or something like that, if they were to fall 50% in a year, that happens all the time. Like that happens all the time to smaller companies. Like they drop 50, 60, 70% in a year. Like that can happen in a snap of fingers. These type of big corporations, like if Apple stock magically went down 50% next year, it would be like earth shaking. Like if Google stock went down 50% next year, like that would mean the whole world's in chaos or something. Like that would be insane, guys. So stick to bigger companies, and also a lot of those bigger companies pay you out dividends, meaning you'll get a little more income into your portfolio. You don't have to, you know, worry so much about gains. You can get some dividends in. You understand these companies better. Stick to the bigger ones. Just go long shares. Don't mess around with some other things like that, guys. Don't mess around with short selling when you're new to the markets. Don't really worry about options when you're new to the market. If you want to learn about it, that's fine. So anyways, I hope you guys enjoyed this. That is your stock market for beginners playbook. If you want to know exactly how I personally pick stocks and what I look for in stocks, click that first link in the description down there. That's my stock market investing mastery course. That's an 11-part course. It even has my private email address in there. So if you have any questions in regards to the course, you can contact me personally and I will contact you back and answer any questions for you guys. Thank you for watching and have a great day.